Hello student, this is in continuation to our previous lecture where we have studied the calculation of cost of debt. In this video we will study the another source of capital, which is preference shares, and to calculate its cost. Preference shares are those shares capital for the firm which is issued to the preference shareholders who enjoy certain preference over ordinary shareholders. Now, what type of preference? A preference in terms of payment of dividend. The preference shareholders enjoys a preference over payment of dividend. Generally, a fixed rate of dividend is paid to preference shareholders, which is specified at the time of issue of preference shares. And another type of preference is at the time of winding up of the company. These preference shareholders are given preference to returning back the capital to preference shareholders over ordinary shareholders. So, the calculation of the cost of preference share is important, so that we can include that in our composite weighted average cost of capital, because the overall capital for the firm will be inclusive of this preference share capital also. So, the cost of preference share capital is that part of cost of capital in which we calculate the amount which is payable to preference shareholders, which has a cost to the firm, and the cost is generally not the dividend amount only, but it also depends upon the net proceed, whether the preference shares are issued at discount or at premium. So, accordingly the formula will be derived. So, to calculate the cost of preference shares, we have to first see what type of preference shares a firm can issue. The preference shares can be redeemable or irredeemable. If I say irredeemable preference share, that means the company do not specify the time duration or the maturity when the share capital will be given back or will be redeemed. So, such preference share capital are irredeemable preference share capital. Or in case of redeemable preference shares, there is a fixed tenure, fixed maturity time. After that, at the end of that time, company will be paying back the principal amount to preference shareholders. Till that time, company will be paying a dividend at a fixed percentage, which is specified at the time of issue of such preference shares. So, the calculation of these two type of preference shares are different. We will see the formula. First, we will take up the cost of preference share of irredeemable preference shares. So, in case of irredeemable preference shares, company has no planning to redeem this preference share in the course of the firm. So, the formula will be KP is denoted as the cost of preference shares is equal to dividend, that is dividend on preference share, which I write as DP over net proceed. DP here is the dividend on preference shares, and net proceed is the amount which a firm get in hands per preference share at the time of issuance. So, why we are writing net proceed, why we are not writing the face value of the preference share? Because net proceed may be different. It may depend that firm is issuing the shares at discount or at premium, and we also take into consideration the cost of issuance also, like flotation cost, commission, printing cost, and all these costs. So, it take into consideration all these amount, and the final amount per preference share that a company gets by issuing preference share is net proceed, right? So, if we divide dividend amount per preference share by the net proceed, we get the cost of preference shares. I will illustrate this with a example. A company issue 20,000 irredeemable preference share at 8%, whose face value is rupees 50, each at 4% discount. Find out the cost of preference share capital. Now, here the face value is rupees 50. Preference dividend is 8%. 8% on what? Preference dividend is always on face value. Remember that. Whether the preference share is issued at premium or at discount, the calculation of dividend will always be on face value. Remember that, right? So, the dividend in this case will be rupees 4, that is 8% on rupees 50, and the proceed, the amount that company will get in hand is not 50 rupees, because company is giving a discount of 4%. So, 4% on 50 rupees is rupees 2. So, company will get rupees 48 per preference share. So, simply we will divide 4 over 48, which is net proceed, and 8.33 will be the cost of preference share in this case. We will take up another example. In this case, we have to find out the cost of 10% irredeemable preference share if issues at 2% premium of rupees 60 each. Now, understand the language. Rupees 60 is the face value in this case. 2% premium is the premium at the time of issue of preference shares. Premium here means this 2% more on face value company will be able to get by issuing preference shares. Now, why a company can get more than its price, more than its face value? Because maybe the intrinsic value is more, or the company's fundamentals are very strong, goodwill is very strong. So, company can get premium over its face value also at the time of issuance. 10% is the dividend rate, and which is also given as rupees 6, which is 10% of rupees 60. Now, flotation cost is rupees 8 per share. Now, what is the role of flotation cost here? 2% premium on rupees 60 is 1.2 rupees. So, company can get 61.2 rupees by issuing per preference share. But at this price, they are also incurring expense of rupees 8 per share also. So, what company will actually get in hand is 61.2 rupees minus 8 rupees, which is 53.2 rupees. So, simply here the cost of preference share will be 6 divided by 53.2, which is 11.27%. Okay. Now, let us move ahead. Let us proceed to our next type of preference share, which is redeemable preference share. Now, redeemable preference share will be redeemed after a fixed tenure. So, we have to take into consideration the redemption value also, because company has this option to redeem preference share at discount, at premium, or at par. At par means on its face value. Depending upon that, the cost of preference share will also differ, right? Because if company is issuing at premium, redeeming at discount, then the cost of preference share will be very less, because this is a favorable proportion for the company. But depending upon the investment scenario, depending upon the market sentiments, company has to decide whether they will be issuing at discount or premium, or whether they will be redeeming at discount or premium, and accordingly we have to modify the formula. So, the formula for redeemable preference share is the KP, here again is the cost of preference share, dividend plus redemption value minus net proceed over N. N here is the period, the time period for preference share maturity. The whole divided by redemption value plus net proceed divided by 2. That means the average of redemption value and net proceed. This is you will find same as what we have done in case of redeemable debenture. But here we will not take into consideration the taxation part. Always remember, because the dividend on preference share will be paid as the appropriation of profit. So, there will be no corporate tax effect on preference share, right? So, taxation part will not be taken in case of calculation of cost of preference share. So, you have to learn this formula, and you can also see if you understand the redemption part and the cost part, then you can understand how this has been derived. So, we will take an illustration here also. Rishi Limited has issued 1009% preference share of rupees 100 each at rupees 95 per share. Now, understand the language here. Rupees 100 each means 100 rupees is the face value. Now, what is the relevance of face value? Because dividend will be calculated on face value only. But at rupees 95 per share, that means company must have given a discount of 5%, 5 rupees discount. The flotation charge are underwriting commission 2%, brokerage 0.5%, and printing rupees 500. The company is planning to redeem this capital after 5 years at a discount of 10%. Find out the cost of capital. Now, a lot of things are given, but just comprehend what is written here, and it will be very easy to put all these things in the formula and get the cost of preference share. What we are going to do here, we know the formula. First, let us calculate the redemption value, right? Redemption value is very simple. They says the company is planning to redeem shares at 10% discount. Now 10% of what? 10% of face value. So 100 rupees is the face value. Company is planning to redeem at 10% discount. So company kitne rupees pay karegi? How much company will pay back? Rupees 90. So redemption value is rupees 90. Now what is the dividend in this case? Dividend is very simple, 9% of face value, because they say 9% preference share. So 9% of rupees 100 will be rupees 9. So dividend in this case is 9. Now the third variable that we need to know is net proceed. Now how to calculate net proceed? Rupees 95 is given, but we have to take into consideration and deduct the cost that is incurred for issue, because that has to be deducted, because company will be getting less of that amount. So what is the cost? Flotation cost, underwriting commission is 2%. Now 2% of what? 2% of rupees 100. That means rupees 2. Now look here, the calculation. Net proceed is 95 minus 2, and 2 I have taken as the underwriting commission. Brokerage 0.5%. 0.5% is 50 paisa in case of 100 face value. So I am deducting per share 50 paisa here also. Now the printing cost is rupees 500. Now this is the lump sum amount. It is not given per share. So we have to convert it into per share. The first line says Rishi Limited has issued 1000 preference shares. 1000 preference share and 500 is the printing cost. So per share, what is the printing expense? It is 50 paisa again. So I am deducting 50 paisa again here. So the net proceed will be 92 rupees. 95 minus rupees 3 as various cost. Put this in the formula, 9 plus 90 minus 92, redemption value minus net proceed divided by 5. Why 5? Because the duration, the tenure of this preference share is 5 years. So divided by 5 over 90 plus 92 divided by 2, which is the average of redemption value and net proceed. You will get the cost of capital as 6.15. So understand what is given in the question. Redemption value and net proceed is the only thing that you have to calculate. Put it in the formula, learn the formula, and the calculation of this preferential cost will be very easy.